What's up guys, it's James out, the out-of-state investor, and today we're going to be talking about 5 cities that are heading towards a much more serious housing correction compared to the rest of the nation. As we've seen mortgage rates rise and housing affordability plummet, we continue to see buying demand weaken across the country, and so far that's resulted already in declines in home prices across the nation of 6% so far. We've also seen nationwide inventory grow drastically in the last 5 months between March and August, and some of these markets, particularly the ones I'm going to talk about in today's video, they are on the fast track to a major housing correction taking place, as some of them have already seen their inventory levels multiply over 5 times the amount they were at just 5 months ago. So naturally, many experts believe that these markets in particular are in great danger of seeing a major housing crash take place. So before I get started, do me a favor and support the channel by smashing that like button, and if you haven't already done so, definitely subscribe, hit that notification bell to watch more content like this. And with that said, let's jump into it. The first market heading towards a major housing correction is the market of San Jose, California. Now, San Jose is where the famous Silicon Valley is located, and it's a tech hub with companies like Apple and Google having their headquarters located there. Well, so far, San Jose has seen the largest house price corrections take place nationwide, as we've seen house prices drop from peak levels a total of 16.9%, and home sales are also down about 26% year over year. Affordability is really the big key factor here in this market, as the median sales price for houses in this market comes out to $1.35 million. So basically, if you were to put a 20% down payment, which is a $270,000 down payment at these current 7% mortgage rates, you'd be looking at a monthly mortgage payment of $7,185 a month. Now, that's not even counting property taxes or insurance costs, which would easily take you up to about $9,000 a month, which means just to stay at about 30% of your income towards housing, you'd have to make an income of $360,000 a year just to afford a median priced home. That's just not affordable anymore. The reality is when interest rates go up, it drastically affects the higher end markets like a San Jose, California, because you see, just in the last 2 months alone, we've seen interest rates climb by about 2%. And for this particular market, that's meant an extra $1,387 a month if you put 20% down on a median priced home. Now, the reason that there's people that can even afford these types of houses in the first place is the really good paying tech jobs. The problem is when an economic recession takes place, the tech sector often sees many job layoffs take place, and so far this year, we've already seen over 42,000 jobs lost in the tech sector. So when you lose that buying pool in an already unaffordable housing market, you're going to start to see some major price drops take place, just like our next market on this list that is seeing more price drops than pretty much anywhere in the entire country, and that's the market of Boise, Idaho. In Boise, we're currently seeing that over 60% of all listings on the market are seeing a price drop take place of some kind, and Moody's Analytics actually reported that Boise is one of the most overvalued markets in the country, about 77% overvalued. This is a big deal because overpriced markets typically see the steepest price declines during a housing crash, and so far we've already seen prices decline from the peak levels a total of 10.8%. Now, keep in mind, this is taking place after an amazing run taking place during the pandemic housing boom, where we saw Boise, Idaho see house prices soar over 50%. But now we're starting to see the complete opposite take place, especially as inventory levels are really starting to build up in this market. You see, we've seen inventory levels rise over 298% in just the last 5 months alone, which is absolutely incredible. And what we've seen is that if you look at this chart, it shows the latest numbers as of August. It's really the highest levels we've seen in at least the last 5 years, according to Realtor.com. We're also seeing something really interesting with Boise, that new listings are actually growing drastically, and that goes completely against what the rest of the country on average is doing, as we've seen new listings decline nationwide. With new listings going up, that only adds adds more pressure to supply building, which causes more pressure for house price declines in the future. Now, in addition to this, we're also seeing homes sit on the market longer, as we've seen the median days on market jump all the way from 7 days on market up to 35 days on market, which is why we've seen so many price drops take place and why homes sold are down actually over 35% year over year in this market. So Boise has a lot of red flags which could lead to some massive price declines in this housing market correction. And another market with some serious red flags that's on this list is the Phoenix, Arizona market. Now, Phoenix, just like Boise, has also been seeing a large increase in inventory take place. And as we know in real estate, the prices of real estate are largely dictated by supply and demand dynamics. So as supply goes up drastically and demand continues to plummet, that's naturally going to lead to price declines taking place in the market. Well, the inventory is up in Phoenix over 317% in the last 5 months alone, and this has taken active listings up to a total of 16,250, which is the highest levels we've seen in the Phoenix area in the last 3 years. Now, as alarming as it is to see the inventory level shoot up that fast, the other thing that's just as alarming to take note of is iBuyers. iBuyers are essentially these institutions like Zillow, Opendoor, OfferPad, although Zillow doesn't really do this anymore, but essentially they buy your home for cash, the whole process takes place online, and they have an online platform dedicated to these services to make it a very easy process to sell your house. Now, Phoenix is pretty unique because they have probably the strongest presence of iBuyers in the entire country. And so what we've seen take place is, if you look at the current amount of single family homes, which is currently at about 15,500 for the Phoenix market, over 1,300 of them are strictly owned by Opendoor. That's just simply one iBuyer owns almost 10% of the entire market's active listings for single family homes. So that's not even including other places like OfferPad or other iBuyers as well. So Phoenix has suffered from iBuyers continuing to offload their inventory, and as prices continue to decline, I believe that's going to continue to be a problem with the extra strong presence of iBuyers in that market. Now, so far prices have only gone down about 7.4% from peak levels, but honestly, I do believe the worst is yet to come for the Phoenix market, as we've seen price drops take place in over 55% of all homes listed on the market. Houses are also sitting on the market a lot longer now. Earlier in the year, we were seeing about 21 median days on market for the Phoenix market. Now that's shot up to 44 days on market as homes just continue to sit there longer, which is why we're seeing the price drops take place. But in addition to that, it's causing housing transactions, or the amount of homes sold, to also go down well over 33% year over year, which is a very bad number, but not nearly as bad as the next market on this list, which is seeing a significant drop in homes sold, and that's the Las Vegas, Nevada market. You see, Las Vegas is currently seeing a 39.7% drop in homes sold, which is one of the highest rates in the nation we've seen of decline in housing transactions take place. And so homes are just simply sitting on the market longer as buying demand continues to drop drastically. We've seen the median days on market go from 14 days on market earlier on in the year, now up to over 44 days on market, more than triple the amount. Now, this has led to over 44.4% of all houses listed on the market seeing a price drop take place of some kind, and so far that's led to a price decline from peak levels of 7.9%. Now, just like Phoenix, I do believe that Las Vegas is just starting to get warmed up. For starters, inventory is up over 192% in just the last 5 months alone, and so we're actually seeing the highest levels of inventory that Las Vegas has seen in at least the last 5 years. Moody's Analytics also reports that Las Vegas is about 59% overvalued according to their calculations, and pending sales also came out, which is a great indicator of what future housing sales looks like, and they came down over 46% year over year, which means housing transactions are likely to just get worse from this point on. So demand is completely plummeted in this market, and I do anticipate we're going to see some significant price declines take place in the near future in this market, but none of these markets that I've talked about so far today worry me more than this next market, and that is the Austin, Texas market. You see, Austin, Texas is looking like things are getting really bad by just about every metric imaginable. Starting with median sales price, we're already down 16.2% from peak levels as far as home price is concerned. What about inventory? Well, inventory is currently up over 435% in just the last 5 months alone. That's more than 5 times the amount of inventory they have in just 5 months. Well, what about price drops? Well, over 50% of the entire Austin market is experiencing a price drop of some kind, especially as homes are continuing to sit on the market longer. We're seeing that median days on market has gone up drastically from 21 days on market earlier on in the year, now sitting at 46 days on market. The reality is that demand destruction is taking place. Buyers are continuing to leave the housing market in Austin, and Moody's Analytics recently reported that Austin is currently 61% overvalued according to their calculations. So between all these metrics, I think it's pretty clear that Austin is going to see some of the biggest price declines take place, and already really has up until this point so far. So with that said, these are the 5 cities that I believe are headed towards massive price corrections taking place in this housing correction. Let me know in the comments below what your thoughts are and what markets you think are headed towards some massive price corrections. So with that said, I hope you guys enjoyed today's video, and if you did and you gained some value, do me a favor and smash that like button, and if you haven't already done so, definitely subscribe and hit that notification bell to watch more content like this. Finally, follow me on Instagram and TikTok at The Out of State Investor, and if you enjoyed today's video, I'm going to highly recommend that you check out one of these 2 videos over here. And with that said, I'll see you guys on the next one.